Welcome to Unearthed, where we unearth all the golden insights about the industry. I'm Joe Cavatoni.
And I'm John Reade. And together we are senior market strategists at the World Gold Council. Today I'm delighted to be joined by Robert Armstrong, who's the US financial markets commentator at the Financial Times. He was also the author of the Unhedged newsletter, which I think is one of the best pieces of content that you can read about financial markets, particularly in the US. And I certainly read it every morning. So, Robert, thank you very much for joining us today.
I'm delighted to be here, and it's nice to see you both again.
The burning question we have is, what are the implications to financial markets from the new Republican administration? Mm-hmm. And obviously we've got Trump returning to the White House. We've got a Republican Senate. We've got a Republican House. What do you think we're going to get from this?
Let's start with the bond market, which has been the biggest move in recent weeks in financial markets. So we've seen a big move up in the yields of longer-term treasuries, the 10 and the 30, and not so much at the short end. So this is a steepening of the yield curve, and the move has been pretty dramatic. So the question is, what is that big move up in yields, which means, of course, a big move down in price? Sure. What is that telling you about expectations for the future? Well, digging down a little bit, what else is going on there? The first culprit we look at in recent years for rising longer yields is it inflation? And I think in this case, it doesn't seem to be. You can never say this conclusively, but inflation expectations or break-even inflation rates haven't gone up that much. So it doesn't look on its face like the market is terrified about inflation getting out of control.
So what could it be then? If it's not inflation.
So if it's not inflation, what? Two candidates. First candidate, the market is just building up higher growth expectations, right? The risk-free asset competes with risk assets and growth assets. If you think growth is going to be great, you demand a higher yield from your bonds because that's always a trade-off.
And you're speaking exclusively about U.S. growth or global growth?
I think it's absolutely exclusively U.S. I mean, this is something we should come back to in our conversation, is what drives a lot of these dynamics, I think in gold and in many other markets, is this incredible contrast between what we're seeing in the U.S. economy and what we're seeing almost everywhere else in the world. But coming back to sort of where we start, candidate explanation one for the higher yields in the long bond is growth. The second alternative is higher uncertainty. So if you think the world is a less certain, scarier, more uncertain place, you want to get paid more on your bonds. If you don't really know what Fed policy is going to look like, if you don't really know what fiscal policy is going to look like, if you don't really know what the geopolitics are going to look like, you say, look, if I'm going to lock my money up in a 10-year bond, I'm going to get paid a little more. I need a margin of safety, right? And that's what we see as a widening what they call term premium, your little extra for tying your money up longer.
Right.
And that could be, look, I need insurance right now. So, and if you look across Wall Street, there's people who are in the growth camp and there's people who are in the uncertainty camp in explaining this move in yields.
It's interesting from our perspective. I mean, we focus very much on the gold market, as you can imagine. And if you think about what's happened since the start of the year, we've seen this big increase in yields.
Yes.
We've seen strength in the US dollar.
Yeah.
Normally, these would be factors that would be putting the gold price under pressure.
Yes.
And yet it isn't.
Yeah.
And I think this fits in very much with the uncertainty aspect that you're highlighting
Yes.
there. The gold market, as we're at about 2,700 at the time of recording, is very much saying that there's a lot more uncertainty out there than there was previously.
It's really funny because, I was kind of looking at the gold numbers before we did this talk. And I was, of course, we had this astonishing rally in the last couple of years. And since about October, the gold price has been kind of range bound.
It most certainly has.
And I was thinking, well, if the world was so uncertain, why isn't gold going up more? But you take the other side of the argument, which is if the world wasn't so uncertain, it would be going down.
That's exactly what we've seen historically.
Right.
But I think the dynamic that's played out so prominently in the gold market this time around has been the global demand dynamics have been so loud and clear
Yes.
that global consumption of the gold market has been up central banks, Eastern investors,
Yes.
and the reliance exclusively on Western investors
Right.
has been diminished somewhat.
Yeah, well, to the degree Western investors are U.S. investors, I mean, this brings us back to this point about the split between the U.S. and the rest of the world.
Yeah.
It's all go in America. Risk assets, business optimism, small business optimism, consumer, retail sales. It's all go. And the rest of the world, Europe, Japan's not too bad. Europe looks like they're having real trouble. China looks like they're having real trouble. The emerging world, if they weren't having trouble before, once the stronger dollar from all our prosperity gets through with them, they'll be having a problem. So it's like, not only do we have this big split between the US and the rest of the world, but it's kind of self-perpetuating through the mechanism of the dollar, right? As we like to say in America, our currency, your problem.
Right.
Right.
But things could change now. We know that there's been a lot of talk from President-elect Trump
Yes.
during the campaign and then since the victory on a number of different areas.
Of course.
And I'd like to try and unpack what could be the consequences of some of the things that we've spoken about. And I think the logical place to start, because it was very prominent, was this conversation about tariffs. What do you think about tariffs and what could happen? When could it happen? And should we be worried about it? And is the market showing any signs of being worried about it?
We should be worried about it. Risk assets don't seem to be particularly worried about it outside of very specific areas. But before we get to what the market's saying, let's kind of peel back a few layers of uncertainty. Trump has cared about tariffs since the 1980s. This is not a passing fancy for him. This is a guy who thinks global trade is a zero-sum game. If someone else is winning, we're losing. It's not the classical economic view, but there it is. And he clearly has to do something about tariffs because he's talked. It's been the main support for his platform is we're going to put tariffs on the rest of the world. We're going to make global trade fair. Fine. We know something is going to happen. What we don't know is what it is. If you look across his economic advisors, if there's 4 or 5 big economic names in the administration, you have 4 or 5 very different opinions about what the tariff policy should be. And indeed, if you listen to Trump from day to day, there are different ideas about what the tariff policy should be.
Would tariffs be inflationary, though? They could put prices up, but would it be a classical inflation that the Federal Reserve should be reacting to?
So a tariff is a one-time change.
Right.
And classically, there's so many variables here, but classically, if you have a one-time shift in prices, that's not the kind of thing the Fed says it's going to talk about. And who knows, the shift in prices will, of course, be very different from product to product.
Sure.
Right? You put a 20% tariff on everything. Not everything is going to change in price by 20%. Is there a domestic substitute for that product? How strong is demand for that product? Et cetera, et cetera. So we'll see different stuff, but all of that should happen once. The question is, do you get a self-perpetuating cycle?
Right.
And I think the economics community has very different views on that. I think, it does mean prices go up, but prices going up once does not inflation make.
But it also is easier for the market to price that in once there's some form of clarity or direction that you can identify.
So it is only the areas of corporate America that are the most obviously and egregiously affected that have shown price action in response to this. If you build houses, the guy who bangs the nails is an immigrant, so we should probably talk about immigration. Yeah. But all the stuff that house is made out of is stuff that is traded on global markets. Tariffs will affect those prices, and the stocks of home builders are it's not that they're crashing, but they're showing fear. There's been an inflection point. So that's an industry, everyone knows it's going to be affected by tariffs, and it's moving.
But you mentioned the construction worker, the immigrant, potentially illegal immigrant building the house. Immigration is something else that Trump has spoken a lot about through the campaign, with talk about cutting immigration and potentially kicking out millions of illegal immigrants. That's got to have an effect, surely.
A big effect, and just on the most basic economic theory, it should have a larger effect on inflation than tariffs. we just talked about how tariffs are potentially a one-time effect, a one-time bump in prices that monetary policy authorities can look through and doesn't start a chain reaction. When we were back in finance school, what did they scare us with tales of? They scared us with tales of the wage price cycle, which is John gets paid more, so John's boss at the World Gold Council has to charge more. Then some other worker sees the prices go up, they demand a higher wages, and the whole thing starts turning over in a self-perpetuating cycle. The price that scares people the most who worry about inflation is the price of labor for that reason.
But it's not like a tariff. You can't, at a stroke of a pen, make 10 million workers disappear.
Yes.
This would have to be the start of probably a long and protracted process.
A grinding process. But you could, I can imagine, all of this stuff is so hard to speculate,
sure.
But I can imagine a situation where you scare people enough that they become much more cautious about who they hire. I don't know if you know anyone who runs a restaurant.
Sure.
But when when you hear stuff on the news and you're thinking about who's working in the back of the shop, is somebody going to walk in tomorrow? Maybe somebody does walk in and say, I'd just like to talk to the people, your porters and your dishwashers or your cooks. So there could be a psychological effect that happens quite quickly. But you're absolutely right. The business of moving, 5% of the U.S. population around. Imagine what kind of job you're talking about doing there, right?
And it's much more complex for people to price that into markets as well.
Yes.
Because you don't really know truly where it's going to hit the economy in different markets.
But I like your point that markets will price in things they know how to price in.
Right.
Right? When they know that something's important, but they can't quite figure out the math of how it's important, they will sometimes hum a little song and pretend that it's not happening, right?
So in that spirit, how are they humming, or what are they humming as it relates to taxes in the U.S., tax reform 2025?
I used the word in the newsletter recently. It's a market in suspense. We absolutely know there will be action on tax policy. There has to be, because the old tax laws are expiring. And if you have a Republican president with a Republican-controlled Senate and a Republican-controlled House, and you don't cut taxes, what are you there for? Right? What is the point of you? Right? So
Something will change at the midterms, right?
Yeah. So whether it is the corporate tax rate, which I think has been priced into the market a little bit. I think it was priced in a lot, and then people sort of realized how complicated things are going to be. And is it the corporate tax rate? Is it, Trump has talked about taxes on Social Security, taxes on tips, taxes on watermelon flavored candy, taxes on moonbeams. So which of these 1,000 proposals are we going to get? I don't know, but we're going to get some of them, right? Which, in a way, circles us back to another question that we began with, which is what's going on with the bond market.
Sure.
So the big question that everybody is asking is, how much is fear about the fiscal situation affecting the price of bonds? If you think that there is going to be a tax cut, and you don't think that, and you would have very good reasons, historical reasons for believing that the tax cut will happen and the promise of spending cuts will not.
Yeah, we're going to come back to that.
Right. If you think deficits, which are now at 6+% of GDP, are going to continue, you start to wonder: are bondholders going to rebel? Is the famous bond vigilante going to reanimate? And so, how much of that is what we're seeing in the bond market? I wish I had a clear answer about that for you, but it's one of the pieces on the chessboard.
It certainly is, and we're perhaps seeing this turn up in other markets,
right?
In the UK, for example,
Of
where
course.
bond market vigilantes do seem to be in the streets of Whitehall at the moment.
And they will be there. There's very good reason for them to be in the UK and not yet in the US. The UK does not have the global currency.
No.
And it is not growing like the US is. A little bit of growth can take you a long way in terms of how much debt you can carry. And a 0.5% or 1% difference in GDP growth makes all the difference in the world for the sustainability of fiscal deficits.
And that's certainly the one thing that the US isn't lacking at the moment. The economy seems to be doing very well still.
We had the reports from the big banks, and there was nothing there to make you think that things are slowing down significantly. But let me ask both of you, who think a lot more about these topics than I do. Say we have a period, where things are really changing, an extremely lively 6 months in terms of the fiscal picture changing. Possibly there'll be changes at the Fed. We can talk about that a little bit. There may be geopolitical changes. What does that leave us thinking about gold and the gold price here?
Should I take that one first?
Yeah.
I mean, I think one of the biggest factors that has changed in the gold market in the last few years has been the increased purchases by central banks.
Yes.
And this is not the United States we're talking about. This is
Right.
the rest of the world, and particularly emerging market central banks.
Right.
I think this is partly being driven by uncertainty, and you have to think that the uncertainty has ratcheted up as a consequence of Trump's victory and the expectation of what those policies are going to be.
Let me stop you for a second. We had this incredible rally, like nothing I'd ever seen, nothing I expected. How much of the incremental buyer, what percentage of the incremental buyer in that rally do you think was central bank buying?
It's a tricky one to answer off the top of my head, but a substantial proportion, and perhaps 50%.
Meaningful.
Meaningful,
really
absolutely. I mean, just to throw some numbers around, out of a roughly 5,000 ton a year gold market, central banks went from buying about 500 tons to buying about 1,000 tons.
Yes.
So you've basically got 10% of demand that came out of the left field that you weren't expecting.
Right.
That was a big part of it. There were other factors too, and they mostly had emerging market characteristics about them. So one of the things Joe and I have spoken a lot about is that Western investors haven't really been involved in this move in gold in the last few years, and to a large extent remain pretty sidelined at the moment. So the two things I'd say is central banks and broader emerging market buyers have been behind this.
Let me add to what John has said. The Western investor may not have been adding gold to their portfolio, but what they haven't done, which they may have done in the past in an environment where real rates have actually been favorable for other assets as opposed to gold, they haven't sold as much as you would expect. The ETF holdings have held firm with dollar appreciation value in gold going up. They've held steady in terms of their holdings, but they haven't been moving more aggressively into allocations.
The surprising thing is that at a historically high level for the gold price, it's not falling.
Correct.
Right? When I was looking back historically, those big rallies in the gold price 15 years ago, those reverted. Right.
Quickly.
You had a spike and you went down. But here we have a spike followed by a plateau, which is kind of interesting.
And actually, the reason it is holding is the Western investor, in particular the U.S. investor, sees the value of the drawdown moment in your portfolio, holding gold, and it does what it needs to do in that moment. So they're keeping the allocation, not increasing the allocation. But to John's point around what's developed in the emerging markets is, interestingly enough, over the last 3 years, what we've seen is a slow, gradual decline in jewelry demand, which has been historically driven by India and China. It was averaging at 10-year averages of about 39 to 40% of demand. It's now dropped to about 36% of demand. And it's being picked up in the Eastern markets by investment demand. A sophisticated investment market in India, China, and Japan have all seen record flows in ETFs in 2024. And the ability to invest in gold in markets like China have never been easier or better.
I mean, I don't know if this is true, but the old cliche was that the jewelry buyer in the East is price sensitive, that they know what this stuff should cost, and they get to a point where they don't want to participate
Look,
anymore.
in the short term, that's true. If the gold price goes up 5-10%, the jewelry buyer stands back.
Yeah.
But what we've seen over the last couple of decades is then the price stabilizes, and they think, well, this is the new price. But what they often will do is they'll buy a certain, I was going to say dollar amount, but that's wrong. It'll be a certain rupee amount of gold. And obviously, it's more expensive in rupee terms, so they're buying less in the way of volume because the price has gone up.
But the investor, the emerging retail investor, is not so price sensitive.
And in fact, can work the other way. They can chase. They can chase prices.
They do. That's actually the interesting thing. They allocate on the basis of how much do I need as a component of a portfolio.
Right.
It's dollar denominated in terms of what they think and need to go and allocate. They don't trade on ounces. They trade assets and value of a portfolio component.
Yeah. I mean, as you know, as John at least knows, I've been, in the past at least, I've been a bit of a gold skeptic. Well, we can talk about my reason for that later, but it seems like a crisis asset to me. And there's a difference between a distress asset. Like bonds are a distress asset. Like when things are bad, when it's raining, you're like, okay, maybe I shift from the risk asset to bonds. It's when there's like hailstones like golf balls, then it's gold time.
Well,
right. So, I mean, is that the right way to think of this? Or
no, I don't think it is. It's partly right.
Yeah.
I mean, there's no doubt about it that when very bad things happen, gold tends to perform well when everything else is falling.
Yeah.
But gold's also been a source of returns over the long term as well. It's not just for the bad times. It's actually for all the time. And we spend a lot of time speaking to investors about why gold should be a strategic allocation to a portfolio, because you get this combination of reasonable returns over the longer term, and then the insurance that it gives you to your portfolio when the bad stuff really happens.
It has a kind of option for very bad times.
What it has is a pretty unique behavior amongst commodities. With wealth creation comes spending. With wealth concern and savings comes squirreling money away. So you can see a use case, which is jewelry and electronics and consumable goods, that comes along with wealth creation, which drives gold up in a good time. And you could also see savings and concern savings in your hurricane or your hailstorm or whatever you refer to in terms of the scary moments, not the rainstorm. So it goes in and it sits. And that's where we've seen the Western investors saying, look, okay, I love the returns I'm getting just on cash alone. We were talking about the 6 to 7 trillion now that sits in money funds alone.
Some of it's my money.
Some of it's your money. It needs to be in gold, but some of it's your money. But the reality is that's money that maybe in the past would have found its way to the gold market. But this is actually a shift that we'll see over time when we can get confidence around wealth creation. I just
feel like right now in the United States, not speaking of the West, but speaking of the United States, risk appetites are just still incredibly robust.
And I think that's right. I mean, and if I had to point at reasons why Western investment demand has been weaker than in other markets, and I think you're right, it's because the good times from investors' perspectives are here in the United States. Europe, where investment in gold has also been weaker, there's a different problem there. It's not that the times are good, it's just that the times aren't bad enough for wanting to reach for your umbrella. You're rather worried about making ends meet.
It's stagnation rather than crisis.
So
I think that's a good characterization.
2 key points to remember about the gold market. The first is that there is an enormous physical market for investment that we track on our quarterly basis that most people don't necessarily remember, particularly in the US. And the second thing is, don't get caught up in what the ETF market loves to talk about, which are flows. They say outflows in gold, inflows in this, and what they're missing is dollar value of the holdings of ETFs outpacing the outflows. So allocations remaining
because
stable.
People are thinking on a percent of portfolio basis.
And they're thinking about what drives their business. Their business is about net new assets and flows, so they're always going to count the numbers that way.
To come back to your question there about what to expect for gold this year, the research team at the World Gold Council published their outlook in December, and one of the things that they said is we're expecting gold to have a much less impressive performance in 2025 than we saw in 2024.
Well, it was a pretty impressive 24. So
exactly, 27% increase in the gold price is not something that investors should expect every year. And look, a lot of what you've said in terms of the way that risk assets may play out this year, perhaps this isn't a terrible time for financial markets that will prompt investors to flood into gold. Perhaps we will see a period of strong growth out of the United States. Perhaps people will not worry about inflation, and maybe the fiscal deficit isn't going to be a big problem, at least this year.
I mean, of course, when you're a financial journalist, you have to make predictions around the turn of the year because, it says so on your financial journalist license. It says you have to make these predictions, even if you're a person who thinks predictions aren't always particularly valuable. And my prediction is, there's going to be more sound than fury. that Trump is a big talker, but we've seen the Trump show before. And on the first episode of the Trump show, there was more bark than bite.
Sure.
And just purely on the basis of that historical experience, I think we're going to see that again. I think the setup for American assets, which is what I write about, is pretty good. Strong economy. Money still wants to come into this country. I just feel like it's going to be an okay year. Again, we've had an unbelievable 2-year run. And for planning purposes, just planning on 20% until you retire from risk assets is probably a bad idea. But, I'm kind of in the camp like we're going to muddle through. It's a muddle through year, despite all the noise. The tails are significant. The possibility of things going really hot or really cold is there.
Any call on the role and the positioning and the relationship with China from the Trump administration? Is that the big game afoot?
I mean, the relationship is pretty cold as it is. So is it going to get worse? I wish I had a deep insight for you. What I'll tell you is it's another area where Trump must be seen to do something. Now, whether he actually, how significant that thing is, but he can't just talk.
Right. And does he have anybody on his list in his administration that could be influential, impactful? I don't see it.
Yeah, no, I don't think so. I mean, the great mystery, and, this is for another podcast perhaps, is, does anyone's voice on the economic team within the administration matter? And if so, who? We have people on a real range of opinions from like quite conventional kind of conservative or Republican economists to real far out kind of trade hawks. And so, it's a team of rivals thing, and it's going to be great for journalists to watch, but probably bad for them to predict.
We haven't spoken about the Fed, and the Fed and its independence are one of the things that worry me.
Yes.
Do you think if inflation were to pick up for normal cyclical reasons, potentially influenced by the labor market, do you think that the Fed's independence will be threatened by Trump?
We know that Trump asked while he was president, can I get rid of this Powell guy? Now that doesn't mean, that's Trump being Trump. That doesn't mean he wants to upset our independent money. It's just something that got said. But when presidents say those things, people are going to read a lot into that question. Even if it's like a kind of stressful Tuesday morning in the White House, that is going to be read into it. What I would say is this: 2 things. One, this administration just won the presidency because the last administration allowed inflation to get out of control. You have to be pretty thick to have that experience and then let inflation get out of control, right? So I think that's pretty vivid in everyone's mind, that you don't want to bully the Fed into keeping policy loose, risk a resurgence of inflation like we had in the 70s and the early 80s, and basically blow up your administration forever. Right. That's point number 1. Point number 2 is, look, we have the same Fed chair until 2026. That's quite a long time. It covers a significant amount, it covers the next year. And it just feels like the situation is going to be pretty stable for the foreseeable.
That's a very logical and rational.
I mean, exactly. Like it makes sense that things would be stable with the Fed.
So, Robert, this has been fascinating in terms of the topic that we've covered.
Yes.
But we're now going to move to the more complex part of the podcast, which is when we ask you for a fun fact on the gold market.
All right. Do I have to go?
We're going to give fun facts? We will, but we're going to let you go first,
so
you can basically embarrass yourself and listen.
I would like you to know that I have brought my entire gold holdings with me today to this podcast because they consist of these gold cufflinks that my late father gave to me when I turned 21. And I love these things. I love how they shine. And I think there's, relevant to our conversation, like you guys are gold guys. I'm not a gold guy, but I have this emotional connection to the metal. right? And I think that it kind of explains a lot about an important part of the power of gold is, why is it a crisis asset? Right? It's because people have an emotional connection to this stuff. And it comes from things like your dad buying you a pair of gold cufflinks or somebody getting you a watch or something getting passed down to you.
Absolutely.
I don't get emotional about my stock portfolio. And sometimes that's good. And sometimes I should get more emotional. But, I think what these cufflinks tell you is that you got to be thinking about emotion when you think of, for good or ill, when you think about gold, you have to think about human emotions.
And I think it shows you there's a genuine use case as well.
Right. It's pretty.
It's pretty. It's emotional, as you've said.
And it's functional.
Yeah, and it keeps my shirt cuffs closed.
It does.
Exactly. So you give me a fun fact.
My fun fact in gold is that is not actually your entire gold holding.
Oh.
Every single person, on average, has 0.2 milligrams of gold within their body.
He did bring it.
I didn't know you were going to say in my body or like my share of as an American citizen in a vault somewhere. I have a little cube with my name on it or my social security number.
Don't.
Unfortunately
not. Cut by dose.
But you contain 0.2 milligrams of gold on average. So bear that in mind.
I'm very happy to hear it. Very happy.
Joe?
So my fun fact is about California. It's about San Francisco. And do you know that the Golden Gate Bridge was not named the Golden Gate Bridge because of the gold rush? Actually, 2 years before the start of the gold rush, in 1846, Captain Fremont for the U.S. Navy.
A familiar name to gold people.
Absolutely.
Yeah.
Found the harbor and said it looks an awful lot like the Golden Horn Harbor in Istanbul, which he said it is a golden harbor for us to trade with the Asian markets. So he named it the Golden Strait, and for which the bridge that crosses it is known as the Golden Gate Bridge.
Those were fun facts.
Those were fun facts. I never know whether to believe Joe, because I never know whether to believe myself.
He made it up on the spot.
Say it with conviction. Thank you, Robert, for joining us on Unearthed. It's been fantastic. We've had a lot of fun and great insight as always. So thank you to our listeners for joining us on Unearthed. You can find our podcast where you find all of your podcasts, or you can find it at goldhub.com. Thanks for joining us.